All right, so I want to welcome you to the pre-workshop meeting number 1 for the Advanced Swing Workshop. It's 15 April 2017. I want to just do a quick introduction and overview of the preparation materials that are on the website. Then I want to address the questions that were submitted. And then I have some additional background and foundational lessons and examples to cover. And my estimate is probably 45 minutes to an hour or so. If at any time questions occur to you, just go ahead, chunk them into the chat room there, and then I will get to them. And I will hang these slides on the web page as well. Okay, so let me shift over to the website and prep material. So I just want to cover the different sections so that you can see what's in each one of them. This first article, the swing article, is sort of a top-down approach to swing trading. It puts it into the context of longer-term trading and short-term trading. I see that swing trading fits in the middle of those and is a really important place to start learning the tortoise material, because being in the middle, there's information content that's in our swing trading systems that can inform the longer-term systems and the shorter-term systems. And similarly, the long-term and short-term systems have information content that can be applied in the swing trade area. So I see swing trading really as the connective tissue between longer-term trading and intraday trading. It can certainly be done just on its own, and we have systems to do that. But the truth of it is, the reality of it is that there's a continuum between long-term and short-term trading, and so all those roads seem to pass through swing trading, and that's why I think it's important. So on the next section here are some just lists the webinars that we'll do in conjunction with the Raleigh workshop. This is where we are right now on April 15th. I plan to do one of these each of the next 2 Saturdays prior to our get-together. And then in between workshop 3 and 4 is where we'll have our 3 or 4 days together. And then my intention is we will do 3 follow-up workshops so that as you have a chance to digest the material that we cover in the residential workshop, that we have a chance there to do some follow-up for clarification, or as you start applying the material, maybe some issues come up, or looking for some clarity that way. So we'll do 3 follow-up sessions as well, and those will all be recorded, and I'll make them available to you for replay in addition. Okay. Right, so in our first webinar, the intention was really to review the mechanical systems definitions, and that really is channeling, overreaction, washout, 551W, 5 days down, triple screen. And those are, I think of those as the 6 mechanical systems that are signal generators for standalone swing trading by the numbers. They can be traded robotically or with 0 or a minimum amount of interpretation. They also form the basis of what I think of as discretionary mechanical trading, in which we identify places in those systems where we can add discretion, add some judgment in ways that suit our personality and our skills and our time, and allow us to improve the performance of those mechanical systems. And the things that we'll cover in the second pre-work and really the advanced topics, the RLCO framework, the Bollinger Band River, these second generation trading strategies that can start with signals that are generated by the mechanical systems and then apply the framework and then look at second generation patterns, allow us, I believe, to really engineer our results in a powerful way. So in webinar 2, what I'm looking at is to give you a chance to digest the RLCO, the regression line crossover Bollinger Band framework, and then what I think of as the most interesting and powerful patterns we have, which is the owl pattern, trading in the pocket, and then essentially allowing us to swing trade one day at a time. That's what we'll do in webinar 2. In webinar 3, there's sort of just a collection of additional topics that may be more psychological. The importance of zero state, trying to integrate the swing trading as part of your larger trading enterprise. And then these elements here, the psychology of stalking, debriefing, the trading as a skill-based activity is really a powerful testimony to what it takes to internalize systems. When you're over here and you have your own thing going on and you get some new information presented, that information and activity is at a distance, and to try to get that internalized is craft work, it is iterative, it is psychological work, it's practice. And so this presentation here, trading as a skill-based activity, makes some very powerful points along that way. These next two, the daily trading plan preparation and execution, I really think those are important pieces of craft work. What it does is walk you through my daily integration plan of how I take these different core, swing, and day trading symbols and how I prepare my trading plan for each day, for each week, and then in the execution, how I actually perform those tasks in the act of trading, and it gives you an idea of what it looks like in action. So I really think our edge is in preparation and planning, and then I also think we have some important pieces of craft knowledge, like the universal entry and the 2R battle drill, that really give us an opportunity to leverage that skill. And what I tell the folks that I coach is that I want them to watch that 2R battle drill video every day for 30 days, and really get that overtrained, get that deep into your consciousness, because it really is where systems meet decision making. The whole purpose of having rules and processes and systems is to standardize and normalize your decision making. And the idea behind the 2R battle drill is that because we are looking for 2-to-1 reward to risk ratios as the minimum criteria for taking trades, that what we hope happens on every trade is that we have a profit target up here, we have an entry down here, and we're accepting this much risk. And we get our entry just like we had hoped for and planned for, and then this thing starts moving out nicely just like we hoped and planned for, and it gets up near a reasonable 2-to-1 profit target, and then starts to starts to decay. Well, this little moment creates some angst because we have two compounding psychological pressures. We have the psychological pressure of a win that we don't want to lose, and then we have the pressure of starting to lose. So both of those make it difficult to execute this decision in a calm manner unless we're prepared for it. The whole idea behind the 2-hour battle drill video and concept is that if there was only one decision that we should rehearse and have mastered to the point where we can execute it without thinking in the same way that we drive a car, it should be what to do when your trade approaches 2R and starts to decay. That's the ideal decision we want to have. We would like to have that kind of difficult decision on every single trade that we make. And so if there was only one decision that we could make that was routine and professional and wouldn't cause us stress, it would be this one. And yet, all of the tension and psychological pressure is built in, as I said, because you have the pressure of a win and the pressure of a loss all conspiring to make this decision very difficult. So by understanding the 2R battle drill and that concept, we want to make that to the point where it takes no extra cognitive cost on us to execute. We should see the pattern. We should have rehearsed it so much that our decision making is automatic, like turn left on the green arrow, turn right on red. We want to make that so routine that it doesn't give us grief in the moment of execution. And that's why I would say I recommend to all my my coaching clients that they should really watch that one every day for 30 days, because every system that I teach places an importance on developing the exits that satisfy your psychology, whether it's core, swing, or intraday. And so the exits, in my view, are the ones where we suffer the most if we're not ready for that psychic pressure. So the combination of the daily trading plan preparation and execution, trading is a skill-based activity, this idea of getting to the zero state where we can make decisions from a disciplined, mature, professional state, the 2R battle drill. These are all psychological components of trading that affect us in the swing trading area as well. And in webinar 3 is where I plan to cover those details. Okay. Moving on. Now, this next section I think is really important. I would watch this like multiple times if you can. These tend to be anywhere from 30 to 90 minutes, if I recall correctly. And what they were is a set of a couple times a week from between March 1st and the middle of April. So that's like 6 weeks. I was doing an online advanced swing trade, teaching all the same concepts that you are seeing here and that you'll see in the workshop, and where many of these shorter videos were recorded. And what we were doing was managing a portfolio of about 20 different stocks and ETFs that are on my normal trading portfolio. And then we traded that forward for 6 weeks. And so each of the weekly lessons included some technical material, but also showed how we were managing the portfolio and bringing it all together. And so if you go through those, you'll see that we were using a combination of mechanical systems, but mostly the advanced patterns that come from the RLCO and the Bollinger Band framework. And then you can see how we use those in practice to manage the trades. What you'll notice is that if we think of the entries or the systems as signal generators, we have a lot of we have the 6 mechanical systems. We have some what I think of as strategies, and that's where they're not as strictly rule-based as the mechanical systems, like the auto framer and the RLF system. But all of these lead to trade frames that produce entries. And then once we're into the position, we really converge on how we manage those. Oops, sorry, that should be an M. On how we manage those positions. We tend to manage and then exit in a standard way. So many reasons to get in, but standard ways to manage by managing our reward and risk and looking at market conditions, and then exiting according to just a couple of rules that satisfy my psychology in my case, or would satisfy your psychology. So what you'll notice is that there's almost like a funnel effect. Many reasons to get in, and then simplified management, and then really strict simplified exiting. And so in my view, most of the importance is in these two areas, in how we manage the trades and how we exit the trades, because those are the decisions that give you specific results. I want you to think of all the entry signals and entry systems as being based on stats. We have some statistical evidence that says that these signals are putting us into a position where over large numbers and long periods of time, we've had a certain advantage in trading from this moment going forward. And so what you're getting on the front end is you're getting the hypothesis and you're buying the possibilities and the potential. Possibilities and potentials. But as you start trading those things forward and you're getting into managing the trades and exiting the trades, you are going from the possible to the actual. And it's the actual results which pay you and which generate most of our anxiety or the psychological pressure. And so in my view then, how we manage the trades and how we exit the trades is really crucial. Signals are important, entry systems are important, so that we're in the favorable territory from our testing. But sorting out the management and exit becomes very important. So, so this section of videos here shows you exactly that, going from start to management to finish, and I really commend those to you to review. Now, so those are all the sections that I strongly recommend. If I could order you to do that, I would order you to do. I would order you to do all those things. The remaining sections are really like a salad bar of things that you can review as it suits you. Right? There's some assorted short concept videos in here. This one is interesting, providing the soundtrack of what's going on in this silent movie. What I do is I show you a trade that's ongoing and that I'm marking up, but I'm not providing the voiceover to it. And after you've listened to a god-awful number of my case studies, and you listen to me as I'm marking up the cases, that's the internal dialogue that I go through as I'm working through the case, as I'm working through the trade. And so at some point, what you can do is say, to see if you've internalized it, you can watch me marking it up, but on silence, and then can you sort out, you could make some notes, what is it that you think I was doing by drawing that blue line or putting that blue circle or underlining that particular area? And then make those notes and then listen to the solution and see how closely your thinking has sort of mirrored mine, and then that will give you an insight into whether or not you're internalizing these ideas. These two sections here, the coaching sessions from Catherine and Kieran, I think are helpful. They're I think anywhere from 90 minutes to 2 hours, but it's like 3 or 4 different traders that have been working through the material at different times, and it gives an example of, in their words, their journey in understanding and internalizing the teachings, and then also how they are using their learning journal and their trading partners to establish accountability and to stay focused on the goals and to make this stuff an internal part of your trading practice, because I know how to trade like I do, and I'm really interested in helping you find the way to apply that stuff in your material. So those two coaching sessions will give you an example of coaching techniques and practice and preparation techniques with learning journals that we have found to be effective. So I would encourage you to listen to those if that appeals to you. This next section is really all about the regression line crossover, and these are different patterns that include how to frame them, how to manage them, how to exit them, how to work your way through some small typical wins, and then how to manage some larger wins. Like here's one for 7R. Here was a 4R win. And so this gives you an idea of how the RLCO pattern works trade by trade. And the key thing to understand about the RLCO framework and these patterns 1 through 7, which are the first generation of the RLCO, it turns out that each of these patterns are not only trading signals, but they actually work as a professional language. They actually allow us to describe what it is that we see. So if we're looking at a situation in the market and we have two different people, X and Y, that are watching that, and X feels an urge to trade, one of the things that Y can do, acting as a trusted friend, say, what is it that makes you want to trade that? What is it that you see? We want to make sure that we are very careful and consistent and precise in looking for our signals. And so to do that, we can use shorthand, like I'm seeing a P1 develop in symbol IWM, the Russell Small Caps. And P1 has some particular considerations. There's a specific definition of what that is. So by us understanding what these different patterns mean, not only can we trade them as signals, but we can also use those to describe what's going on. And what you'll see is that when we get into the second generation of RLCO, like the OWL and the Z3P patterns, which, by the way, work on multiple time frames, it turns out that the OWL is a refinement of pattern 1, and that the Z3P is a refinement of pattern 5. It just puts more criteria on them. As we have learned through trading these things in practice, that there are ways to improve on the original pattern. So we can use these patterns in this language to be very precise about what it is that we're seeing, and then that becomes ways to develop systems and to check our performance so that we're not trading by instinct or by feeling, but we're actually using a professional language and structure to shape our decision making. And that helps us from losing our mind, actually, because we can now talk about what's going on in the market in calm, almost methodical fashion, and we take a lot of the anxiety out of what it is we're doing. So the RLCO pattern then turns out to be, this framework and these signals turn out to be fractal in nature, all right? And by that, what I mean is that when you see a pattern, if you see a P1 on 1 minute charts all the way out to 1 month charts and anywhere in between, that what that means in terms of characterizing the market conditions is identical. It interprets exactly the same way. So a P1, for example, is defined as the market may have been mucking along here and then made an extraordinary move in one direction away from the previous condition, and then has started, it no longer is failing, but has started to roll over and is moving backwards. And if we plotted the mean of this price, what we would say is that if we are playing a reversion to the mean, we wouldn't be surprised if price moved back to here. And so the P1 pattern says that this leg is the tradable opportunity if it meets your reward to risk criteria, that this move was significant enough that the reaction to that move may be tradable if it simply reverts to the mean. And that interpretation is identical whether I'm looking at 1 minute charts or 1 month charts or any place in between. And so the power of this RLCO framework, based on statistics and based on time and distance that price is moved, gives us the ability to structure in a very systematic way a trade frame that allows us to say, is this opportunity large enough for us to manage so that we can see a 2-to-1 reward to risk? And can we, and if price is moving in our direction, is that a tradable moment? So the RLCO framework gives us a very flexible, robust, math-oriented way of describing and structuring our view of price action. And so the fact that we can use math and that we can be flexible in time frames and that we can use this professional language all give us edges. These all give us an edge compared to the herd animals that are trading from the hip or can only trade one system or can only trade in one way. What we have is a flexible, robust, adaptive framework for making decisions. And so this section gives you about 20 different examples of RLCO trades from entry all the way to exiting. So I would offer those to you for review as well. These sections here in the middle, the slides, first one, flashcards. This is a powerful insight from our chat room and from a lot of our live trading workshops. What we've discovered is that when you have a certain amount of theoretical knowledge and then you try to put that into action and the world intervenes, this gets very challenging and there's a struggle going on because trading is an action-based activity, and sometimes out of that fog of war, out of that cloud of dust, we get these little flashes of aha, moments of clarity in which the essence of the lesson really comes through clearly, and we want to lock that in. So what we have been doing a lot of is making flashcards of those lessons, usually starting off as sketches and drawing upon our creative energies and insights to really express the feelings and the thinking and the activity. And we make that a flashcard or a sketch. And then these flashcards become touchstones or checkpoints or ways to really lock in our important lessons. And so this section here is about, I want to say, something like 50 of our biggest lessons that come out of these moments of engaging with the market. There's a lot of synergy in those. There's a lot of powerful insights that were aha moments that we want to capture. And so by creating those flashcards for ourselves and then sharing them, we're able to get a quick gestalt, if you will, a flash of insight that reminds us the essential elements of what it is that we want to do. And so there's a couple of things I'd like to compare that to. If you watch professional football and they have their little playbooks, and quite often you'll see the team that wins is the ones that have trained better on their standard plays. And they use the flashcards or those little diagrams as ways to really activate their memory and their training and to bring it all forward into the present. The flashcard allows you to really lock in those ways of thinking and essentially to program your mind to behave the way you want it to under moments of stress. So it works that way in football. It also works that way in military training. For almost 40 years, I've been involved in helping soldiers fight, win, and survive and come home again from combat. And the way we do that is to find those most important battlefield lessons, train them and overtrain them so that it becomes a matter of instinct leading to action. And we use flashcards to help overtrain those critical tasks. So our experience has been that trading shares a lot of similarities to competitive athletic performance and with combat survival skills. And both of those activities seem to connect in a very deep level to our existence as mammals that have evolved over millions of years, whose mind and body has been wired to behave in certain ways during peak performance under moments of stress. And so when we add reflection, when we use critical thinking and study our results and our actions, and this is where the trading journal comes in, when we use reflective thinking to examine our behavior and analyze it, quite often we get these flashes of insight into lessons learned, which by converting to flashcards become ways of really reestablishing our connection to that moment of insight and ways of reinforcing the lessons that we've learned. So these flashcards we'd offer to you as things that have resonated with dozens of traders that are seeking to master the tortoise techniques. And this is, they apply to day trading, to swing trading, to core trading as well. Those flashcards are mine. These first 50 nuggets are essentially our awesome trader Catherine Crusel's inspirational flashcards about her learning journey. And you will see they're very elegant and evocative, and they speak to important lessons that I believe all traders need to contend with and find ways to resolve. And so we offer those to you as ways to learn how to put this stuff into action. The how to read the daily reports is really nothing more than just the standard practice of taking the daily and weekend reports and using that to come up with a set of symbols that you're going to prepare. Okay, so the whole point of the weekend report is to come up with a plan on certain symbols to trade, and then the next step is you go into preparation so that you have a detailed trading plan for those, and then you can move into execution when you actually put them into practice based on the preparation that you've done. And then the final step in that sequence is assessment. And so when we think about plan, prepare, execute, and assess, it's the assessment that allows us to go back and look at how well did we execute, how well did we prepare, how well did we plan, how well did we follow through in a logical fashion, and then we can actually assess our assessment. Am I doing my assessment? Am I improving my standards? am I following through on the lessons learned? So assessment itself, you can do some meta assessment on your assessment. There's a lot of assessing going on in here. That's what we mean by reflecting. This is what we mean by a systems approach to continuous improvement: plan, prepare, execute, and assess. The two things that are the hardest work are the preparation that it goes into being ready, in my view, and on the commitment to assessing your performance, because we have to look in the mirror and see what we're doing right and doing wrong. Those are where the hardest work is. If we have trained ourselves properly and we understand our planning and preparation or systems, execution should be a matter of routine. It shouldn't be a lot of cognitive effort on that compared to what it takes to the hard work of preparing, to the hard work of assessing. The planning is relatively easy because we're doing that in a consistent way, and we can generate an awful lot of high quality potential trades that we can then do the hard work to prepare. Well, that's some learning theory and reflective learning and trade journaling and some of that. And that you'll get some of those pieces in here. Now, these sample trades are things that are related directly to the first generation mechanical symbol or mechanical signals that were contained in the basic swing trading course. And these things are still valid, and they can be traded as you see. But my spider sense tells me that when we add the RLCO Bollinger Band framework, that we can really improve the way we manage and exit those trades. By adding this framework plus the second generation pattern. So the framework allows us to interpret the price action here, and then we have those P1 through P7 patterns, which they themselves are additional swing trade generators, and then the refinement into second generation, like the owl and the pocket and the C3P series. All of these things taken together add additional value in the advanced course, my proposal is to spend most of our time out here. But I do think it's important that you understand the foundational work of the mechanical symbols, because this is the way I started. I mean, I started with mechanical I started mechanical so that I could minimize my discretionary activity. I wanted to become more rules-based. And as I became comfortable and competent with that, I then found ways to start adding value through my trading judgment. And it turns out that's what leads to improvements like RLCO, Bollinger Bands, the patterns, and the second generation, and so forth. So I do want to make sure that you have access to those sample trades so that you can be clear in your understanding of the mechanical systems. Just listen to me talk. Here it is, 3:42. We're already 40 minutes into this thing. Yeah, that's what happens sometimes. These next sections, these quizzes are very effective in helping you check your own learning on RLCOs. I've marked up a bunch of different trade frames and setups and management, and you can take those quizzes and then look at the solutions to check your own learning. The chat room debriefings, these are examples of how we use the chat room in practice. And it's sort of like, in-stride coaching. And a lot of folks will say and confirm that the real workshop consists of what we do in the chat room with these debriefings, that the workshops help you learn the material conceptually, but putting it into action and going through structured coaching and assessment is really how you lock in those lessons. So these are examples of what we do in the chat room. Now, what I will tell you is later this afternoon or after this workshop, I'll be sending you all an invite to the chat room so that you can start seeing what we do there as my guest. I invite you to, you're invited to stay there as long as you want as a guest until you make a decision of what, whether it adds value or not. We can talk more about that, in person. But because of the courage and the risk that you are taking on by, attending the workshops and all that, I figured the least I can do is give you access to the area where we really put it together. That's really where the work of the workshop is done on an ongoing basis. And then those, if you do that, then I think you can generate some additional questions for the follow-on webinars to really lock in the learning. These strategy and concept videos are really just things that we have learned about tortoise style trading over the years, which apply to every time period and trading in this style. Here's just some more documentation and some essays on trading itself. A lot of these I wrote, these essays on trading are all tend to be about one-page detailed discussions, or as detailed as you can be on one page, but on a single concept that pulls things together, and they're organized by beliefs about system, self, and market, and they really document in a deeper way my opinions, my perspectives on trading that have been hammered out through 20 to 30 years of trading, and then in the engagement in the chat room over the last 7 or 8 years. So I'd offer those to you. This Ready, Fire, Aim ebook from 2008 is a tribute to my dear and now recently departed friend and mentor, Mark McDowell, God bless him, a genuine angel and a powerful force for good in the world. From about 2005 through 2008, he was following me through the chat room and analyzing the things that I was doing, and we turned that into a structured approach to adaptive trading. Many of those lessons learned then became the groundwork to become more formalized in what became the RLCO framework and the frog day trading system. And this was really the first effort to try to get from discretionary towards rule-based, or at least to move closer to the middle. And it really shows the evolution of thought in managing reward and risk, and knowing where you are in the trade at all times and what the market's doing around your trade. And so that's been a pretty popular ebook on Amazon, and it really describes what I'm doing when I'm not following a particular mechanical system. It generally looks an awful lot like this Ready, Fire, Aim, that I'm finding favorable moments to trade where I think I can see a reward and a risk that I can manage, and I put some structure on it. By adding the RLCO framework to it, this has become even more powerful. And then enough of those were so successful that they became the pattern 1 through pattern 7s of the RLCO framework. So I think of this one really as the early heroic days of trying to become more rules-based by describing exactly what it was that I was doing. And Mark acted as a trusted friend who kept pushing me to define with precision what I was seeing and what I was doing and why, so that we could then subject that to analysis and statistical treatment. The final section, these other adaptations, these are systems level descriptions that 3 students and friends have done. The first one, John Gowing, put together the RLCO strategy into swing trading. I had been using it only for day trading up to that point, but he came into one of our research weekends that we do annually out here in Kansas, Next one is in June, by the way. And he brought in his application of RLCO trading to a swing time frame with considerable success. And so um, that's his application that really suits him. As a result of that research weekend, John retired from his consulting work, got his RIA license, is now a full-time professional money manager using different forms of these systems in his work. The next one, Kim's RLCO trading description, is Kim Anderson's approach. She's a trading goddess, and she has specialized in one of the patterns that we call now pattern 6, the Anderson regression line stretch. And this is the way that she has internalized the RLCO system, and a lot of folks have found that to be sensible, and it resonates with them and sort of gives you confidence that you can take this material and shape it into a way that fits inside your belief systems and your execution ability. The last one I just put on there, Matt Blankenship's frog trading. This is really more about day trading, but one of the advanced topics that we'll look at is what I call core and turbo, and that is that we've got a swing trade that we think is going to, if it works out properly, is going to last anywhere from 1 to 5 days, and then as it gets close to this 5th day, we should be seeing some exit signals starting to develop. And if we do, there's ways of drilling down inside that day and applying some of our adaptive principles to improve our exits or to get the most that we can out of that particular day. So you don't have to be a day trader, but if you ever wanted to refine the system by drilling down a time frame, you could do that. And then Matt's workshop, the frog trading analysis, is one of the ways that we teach on how to do that, where it is so rule-based and mechanical that there's not a lot of discretion involved unless you insist on doing it that way. So that's a quick tour of all that preparation material. And like I said, for workshop 2 next Saturday, these are the ones that I would really like to focus on. You know, the RLCO, the Bollinger Band, Plan, Prepare, Execute, Trading in the Pocket, the 2R battle drill, swing trading 1 day at a time. This is sort of implementation of the advanced strategies. And then again, I only had a few questions asked about these mechanical systems, and I'm going to cover those next. But if you didn't get a chance to kind of refresh and you have any questions from here that we want to roll into webinar 2, that's certainly feasible, because what I want to do is make sure that we don't have to spend any of our time in the residential workshop with basic questions about these systems. If I get them, I'll still address them, but we'll do them at lunchtime or whatever. But I'd really like to have a clear understanding on the basic mechanical systems before we link up in Raleigh. Okay, so that's everything I want to say about that. I will be sending you the invites to the chat room later today, and you can navigate around in there, and I think it's pretty straightforward on how it all works. But that will give us a chance to practice some of that craft work prior to the workshop. And you'll see us in the workshop using that chat room too. We maintain contact with the folks and share insights and whatnot. Okay, so I now want to I propose that I have said everything I wanted to say about the introduction and the overview. I'm ready to go into the FAQs now with your permission. And I don't see any questions in the box. That either means I am unusually clear, or you are very, very polite, or the internet connection has failed. So we'll see which one of those explanations matter. So a couple folks pointed out that I had cross-linked the triple screen notes and the swing summary. That's cleaned up now. The swing summary just shows like a paragraph description of some non-systems or some advanced strategies that we use. So we got that clear. And then there were two other particular questions. One was on the universal entry, and one was on shorting on failure. And so I want to cover those next with our time remaining. We've got about probably 10 minutes to stay within our hour, and I will explain these fully, and if it goes over a little bit, so be it. So the first question was, on the universal entry continuation trade, could I provide a bit more detail on how it works for the end of the day trader, and perhaps with an example? Yes, I can. So. All right, so the main idea behind the universal entry and the continuation pattern was this thing. This is an example of the triple screen pattern where we have a strong move where it was stronger than the market, and we have ways to measure that. So it had a very strong move, and then it had an orderly pullback, and then there was evidence that the pattern was continuing. And then on the basis of this, we could, because of the strength of this first move, we wouldn't be surprised that if another move of the same magnitude would occur, that quite often the market is symmetrical that way. And so we put some trade structure in here and said if it just got back to the swing high, we might be able to trade just this distance. And then if it actually gets through, we could maybe add a second position here, and then we would really be able to optimize a non-surprising move. That's the main idea behind the triple screen. Well, one of the things that I noticed with the 6 mechanical systems was, like, on a 5-day down pattern, 5 lower closes, we would frame that trade so that if it went above the 5th day's high, we would trigger an entry, and we'd look for a 10-day high as the 2-to-1 reward to risk ratio, and we would take that trade. And so this turns out to be a really good pattern in bull markets. And so the trade would happen, and then we would maybe book the profit, and then we would just look for, and then that would be the end of it. And then sometimes when I was doing my assessment, I would go back and look at this signal, and what I would see was it turned out that thing had done 5 days down, and here was our trade, and this was the trade that we captured. But then it exited, but it kept doing these kinds of things. And I noticed that what I was doing, I was getting these first moves, and yet the thing was behaving in an orderly manner where each of the up moves was overwhelming the measured down move. But if these weren't all 5 days down, then that signal wasn't coming up again, because it takes a pretty special condition to get 5 days down in a row. If you only get 4 days down in a row and then it takes off, you wouldn't see that second move. So when I looked at the performance of the mechanical systems in general, what I noticed was that this was true for most of the swing trades, that I was getting good first trades out of them, but I was missing what I came to describe as the continuation pattern. And what that means is that when that continuation pattern means some smart, brave first mouse started the turnaround and it started to resume, and I wanted to find a way to be a second mouse to take a position after the move had started, so that if the third, fourth, and fifth mouse came in with lots of markets money, then I could get carried on to victory. So that's the main idea behind the continuation trade, and that is that bodies in motion tend to stay in motion. So if we had a strong move and we booked a trade, what I mean by a continuation pattern then is that if when I structured this trade, I would say, look, if this thing rolls over and instead of going up to 2R, it comes down and takes my 1R protective stop, then this trade signal is over. But if I cash a winning trade, it doesn't have to be 2R, but if I cash a winning trade because there was some pullback, but then it starts to resume, as long as the recent swing low is better than my initial stop, I consider that to be a continuation pattern. All right? So that the original stop is still in place, that the main idea behind this resumption of the trade is still valid, and that I just got taken out early, but I can still take this trade. And so the continuation pattern was born. So what I want you to think about now is that we've got these 6 different mechanical swing systems, each one with its own logic, each one with its own idea. And if we cash a winning trade, but the original stop loss never gets hit and the thing dips and then starts to take off again, that as long as it takes out that previous bar's high, we now have a universal entry as possible. I can now get back into that trade because I saw enough positive price action that negates the negative price action. So this positive action makes this as if it never happened, and now all I'm doing is continuing that first pattern up. And so the specific definition then of the universal entry looks like this. That we had a successful trade, so after a successful trade, whose exit was triggered by selling pressure, so there was some selling pressure of some type, I look for a re-entry using the universal entry. So after the sell day, and let's say that this was the sell day, after the sell day which triggered the exit, I will buy it today if it opened inside yesterday's real body, so this is what I call an orderly entry, because it did a gap outside of the previous day's range says something extraordinary happened overnight. I want a nice, quiet, orderly resumption. It sold off to here, and now it opens inside yesterday's real body, and now takes out yesterday's high. That creates the universal entry. And so what the universal entry does then is that this is a module, this is a pattern or a strategy or a concept that says the continuation pattern plus the universal entry on how to get in applies equally to every one of these 6 mechanical systems. In a sense, it's a 7th pattern. And the universal entry is the definition of what I'm looking for so that this is an orderly move. So let's say we had a trade that looked like this. Maybe there was a big sell, whether this was a triple screen or a 5-day down or a washout. We had some kind of big sell that creates a swing high that is our new price target, and then price starts moving in these directions. Now maybe this was a washout pattern, maybe this was a 5-day down, maybe this was a triple screen or a 551W anyway, and I get an entry somewhere around step 3 or step 4, and then I get this positive trade, and then on day 6 is the sell day, and because I'm able to sell somewhere around in here, I was able to book this profit. So that says I had a successful trade. And then I sold because of day 6. Day 7 now, day 7 is a universal entry and it's the day that I enter because it took out the high of day 6. It opened in an orderly way inside the body of day 6. It took out day 6's high by 5 cents. And I say 5 cents for things that are, not more than $100 a share. If you're trading Amazon or Google, Tesla, or something that's well over $100, that buffer might need to be bigger than 5 cents, but generally speaking, this is a buffer that says I only need a little bit of price action above yesterday's high to confirm that we have new buying interest, that they're now starting to buy it at a price higher than they could even achieve on the selling day. So that says there is new buying interest, and that's the logic which says that the universal entry is a reasonable re-entry. So that's what I mean by the universal entry. Let me see. Let me give you a live example of that one. I think I have one in here somewhere. Let me try to zoom this in a little bit. All right, so this is what we call the owl pattern. There was step 1, there was a big sell-off. Step 2, there was a regression line crossover outside of the river. Step 3, the RL10, the 10-period regression line, has crossed through this orange-looking dragon. Step 4, the dragon, which is this red dot, has rolled and started to roll up. And then the 30-period regression line has started to roll up, and that puts an owl entry right here at step number 6. Now this other green dot, which normally signals an entry, where this is a buying signal, this was actually the exit signal on what was a short side trade that terminated after the trending move was over, and we saw this RLCO happen. That was enough reason to get out. This is actually the exit on the last trade, and that's what this black box means, is that trade was over. And then we started seeing that in the price improvement that was happening, we saw the beginnings of an owl. So the owl pattern is number 6 and going the other way. So let's see what a successful owl looks like. There we go. All right, so now we have an owl trade, and we start moving. And one of the things that could happen is that this much price action could cause us to actually exit, depending on how you have decided to structure your exit. You might say, this was such an exceptional move that this failure to follow through, this RLCO pattern outside of the river, see it's outside of the river, this might be enough to be an exit. If I exited here, then this would have been a successful owl trade, and now this bar could become a re-entry when it takes out the high of the selling day. So let's see if we can zoom in on that and see what I mean. So the first thing, we had to have a successful trade, and then maybe here it gapped up right to Z2 and then sold off on this day. The second day it opened where it closed. It went up, it made a lower high, sold off, and then had no follow through. So this is already feeling negative. And then the third day, it really didn't do anything at all. And that might be enough for me to say it didn't resume, and I'm worried about the downside. And because I see the dragon is out of the river, I now have reason to be concerned that it could move back to the RL270 or back to the Bollinger Band mean, and then an adverse move of this magnitude would negate all of the positive gains that I had made over 7 or 8 days. It could make that move in 1 or 2 days. And so maybe on the basis of that logic, I decide I want to exit here. So that now becomes my selling day. And now the next day, what happens, it opens, so now we're looking at this little gizmo. It opens here, sells off, but doesn't even get through the dragon. And then it reverses and then closes with a powerful move up. And in fact, so this is the kind of move that I like to get. Or it could have been, maybe I was able to stay the entire distance, and then this selling pressure, which is where I actually sold, in fact, it didn't fail further and come back to the Bollinger Band mean. Maybe right in here, I can get a universal entry because it looks like it's starting to resume. I could even enter here if I treated this one as a low, a higher low, and when it takes out that day's high, this could be a universal entry. As long as my original stop loss was not violated, in this case, if I put a stop below here, I would treat that as a reasonable stop. As long as that wasn't violated, I can re-enter here. And that's what I mean by a continuation pattern. Now, in the RLCO framework in the second generation, we've actually refined that understanding a little more carefully. And we've defined it as a pocket. So now what we look for in the second generation are these things like this, where you have the RL10 has moved up and you have a measured swing low and it starts to resume. We're looking for continuation trades inside here, and we're looking for universal entries in there to make our entries. Now, in one way of looking at this back here, this first green dot actually is not only the exit of this successful trade, it could also be, this is also a P1 entry because it's a universal entry after an RLCO. Now, if I had cashed in here, this owl pattern actually is a continuation of the first successful P1 trade. What we have discovered is that this first P1 fails often enough that there's a good reason to wait for the conditions of the owl to occur and to take the second trade. And this is one of the ways that the first generation pattern has morphed into a second generation pattern that we call the owl, because it is a wise decision to wait for the additional confirmation that the dragon has rolled over and that the RL30 has started to roll up, that there's wisdom in waiting for that decision. The other thing that we know in one of our second generation patterns, is the P1F trade, which is when the P1 trade, which is this first one, when that fails, what you end up getting is quite often a second leg. Let me clean this up. That this first leg down, which got all of the price and the dragon and everything out of the river, that's what we mean by trending behavior. There's nothing in the river. The P1 trade is a counter trend trade. It tries to go back towards the Bollinger Band mean. But this thing fails so often that what we discovered was it was a wise owl. The wise owl waits. That by waiting for the continuation trade, that it doesn't fail here, that it it gets all the way through the dragon. The dragon is rolled up. The 30 is rolled up. By waiting for that trade, you are wise. And we also now put an automatic P1 failure entry in here, so that if this P1 signal occurs after a strong move and it starts, you get a P1 entry signal, but you wait, and then it fails. When it fails through the bottom of the RL10, this now becomes what we call the P1 failure trade. And then the size of this leg is quite often the size of that leg. And the size of this leg on a successful owl is the size of that leg. So you have a downward move, and it comes to a moment of decision at P1. By waiting for the owl, you still can participate in a big move up, but it also gives you the opportunity to play the P1F trade in which way it goes. So now the P1, instead of being the primary trading signal, it really is an information signal that says you are now in a critical state in which an owl move or a P1 failure trade is a very good move. The only other thing that can happen is that instead of breaking out for an owl or P1 failure, you get some kind of tight sideways quiet channel, and oh, by the way, this now becomes the criteria for a P5. So by waiting at a P1, instead of trying to immediately trade it all the time, waiting for an owl or a P1 failure or a sideways quiet channel, which if it gets really quiet can get so narrowly focused that this becomes a Z3 trade, we now have a second generation of trading that rewards us for our deeper understanding of these patterns on the basis of the RLCO framework. So that's sort of the relationship now between the universal entry and the continuation trade. And then what happens when you start putting this RLCO Bollinger Band framework on it? It now becomes a very powerful way to leverage your knowledge and your understanding, which is based on mathematics and statistics, and that gives you an edge. So that's what I wanted to say about that. Let's see. Let me check some other questions. So that was the question on the universal entry. The second question, let me zoom back up here. All right, so question number 2. Shorting on failure. Again, for an end-of-day trade order setup, would there be any limit to guard against a gap down on the failure, and or how much of a gap down is reasonable to still trigger a sell? Or should the plan be to just get short at any price? Here's the way I work through that question. The question is really, we've set up a structured trade, but now we have a gap. So the first thing that I want to say is on the mechanical systems, no matter what pattern got you into the frame, we're going to frame it in exactly the same way. Maybe it was a 5-day down. Maybe there was a strong previous move, and so this could have been a triple screen or a 551W. A triple screen had a strong move. It pulled back. It didn't have to be 5 days down in a row. It was just a pullback that got it below the 20-day moving average, and now we have the triple screen is created. Or this could have been a 551W, and then this could have been a white candle in which we were, in the 551W, we're higher than we were 5 weeks ago. We're lower than we were 5 days ago. And yesterday was a white candle, meaning that there's some buying pressure coming in, and now we want to buy a continuation, and we always think that this trade is going to go that way. Okay, so when we frame this trade with end of day data in the usual way, we take the signal day and we put that 5-cent buffer above and below. We make an orderly estimate. We say maybe this was the 10-day high, and maybe this is the last place that there was support, and we draw the purple line to indicate what we think the reasonable target for upside and downside movement is within the swing trade time frame. What could it reasonably get to in the next 5 or 10 days so that we can judge reward to risk? Well, what I call an orderly entry is this. An orderly entry is when it opens inside yesterday's real body. I will also say, I will accept a definition that says inside yesterday's range. The reason I say that's orderly is because it opens at a price that we saw the day before. If it gaps above yesterday's high or low, then something happened in the overnight market, which now makes this a disorderly entry. What I really want is nothing special overnight. It opens inside here, and then if I'm going long, when it crosses the green line, I can get long. And then my goal is to manage this, and hopefully it gets to my, in this case, 3R win. So if I have my entry at the green line and my initial stop at the red line, the initial stop has a logic similar to the entry. The initial stop says, in this critical moment, if it gets above yesterday's high, then I have price evidence that the move to the purple line is happening. Similarly, if price opens inside yesterday's range, but now starts to fail, if it gets lower than it ever got to yesterday, I now have evidence that whatever was driving this retracement is going to continue. And so I no longer want to be in that trade because I have evidence that the trade is failing. Now the 5DDF, the failure pattern, occurred because when we analyzed hundreds of 5DD and triple screen and 551 trades, what we discovered was that in bear markets, certainly, and sometimes in sideways markets, but really in bear markets, that when we got this failure pattern, this was a really good trade, that you could actually frame that as its own system. And in fact, the best ones never even got through the green line. It just opened inside here and then started to fail. But what we also discovered was even on the ones that opened in an orderly fashion, and then you got an entry, and then it failed back through the first red line, even if you cashed a winning trade, if this thing just kept going and you never got the universal entry for continuation, but it just kept failing, it went through the original red line, that this was a good trade in bear markets for the 5-day down and the washout. So those patterns became a washout failure, WOF, and a 5DDF. So that's some insights into the trade frame. Now let me get to the specific question. What happens if you get an orderly or a disorderly entry? Let me show you the concept. In this case, when I'm doing my trade frame and I find my 1R, and then I find my price point that connects to a 10-day high or the next level of resistance, I then take this R multiple and I say, well, here's 1R, 2R, 3R. I now have a 3-to-1 reward to risk ratio if I get an orderly entry. So I want to take that trade if I get an orderly entry and it takes off. I want to take that trade. And then the same thing If it's a 5D, if it's a failure pattern, I want to go to the downside. And so now the question is, what happens if it gaps up? What if it's not an orderly entry? Let me try to zoom this in so you can, I should have done that earlier. All right, so now I have some gap into this white space. I have gapped above this green line. Can I still take that trade? Here's the way that I do that. I can come over here. I'm going to make an assessment of reward to risk. And I've already done that with my original trade frame. But if there's a gap, I can say there is some maximum price when using the original initial stop that allows me to maintain my reward to risk criteria. And so if my reward to risk criteria is 2 to 1, this is what I can do. I maintain my initial stop, and then I divide this into 3 segments. And now I say I can buy a gap if it gaps up between the green line and the dotted blue line. I can buy that because my risk in this case is now the orange box, and I have 2 of those reasonably available up to my profit target. So what I will tell you then, to answer your question, and it works exactly the same way on the bottom, that I can using the same initial stop, I can automatically buy a gap up of that much above yesterday's high. Now, the next question would be is, well, what if it gaps higher than the blue line and is just taking off like a scalded ape and the rest of the market is working? Can I buy it at the red line and use a stop of my first amount of risk? I can buy it at the red line and then use a stop of 1 box as my real risk. So I'm not taking the original stop loss. I would tell you, this is a case where you really want to trade that thing, don't you? I would never say to do that as part of the mechanical system. Don't do that as part of the mechanical system. What you have is a different pattern that you want to trade. And if you want to trade that pattern, it better be because you have done the math on it and done the analysis, which says that if I get an extraordinary gap, that I can trade this because it pays off all on its own merits. And now what you have is a second system. You have a different system that you want to trade. I will tell you that is well suited for day trading, but it's not well suited for swing trading in my experience. That what works in swing trading is an orderly entry and a quiet, natural resumption of these longer-term trades. If you get a big gap up and it's starting to run away, what you have is not a swing trade continuation here. What you have is that there was some news event that's being responded to with violence, and that's not a good swing trade. That's not consistent with the earlier logic. That's a day trade. Excuse me, in my opinion. So I would not do that as part of a mechanical swing trading system. If I'm a day trader, I can use that as an opportunity to trade intraday, but not as a swing trader. Now that's an example of how we can use swing trading systems to provide information to the shorter time frame. That's what I mean by swing trading one day at a time. I might just plan on only doing that one day worth of trade and then letting the smoke clear with no intention of keeping it as a swing trade. And so I can use swing trade signals to posture me for high payoff targets as a day trader. That's an advanced technique. So that's what I mean when I say, if you want to trade the gap outside of the framed area, and that's from this red dotted line and above, you must have proof that that pattern you want to trade has positive expectancy. In my opinion, though, you can trade in this orange area. You can trade this small gap up to the blue line because you're still using the initial logic and you still have a 2-to-1 reward to risk ratio. But what I want you to notice is that when you do that, you'll be trading a smaller position size because you're using this risk as your 1R. So when you take your constant R per trade and you divide that by the larger stop, you actually get a smaller position size. And that's a risk management technique that works in your favor because it's reducing the risk when you have an unusual event like this gap that you can trade. Now, the specific question that was asked was on the was if you were going short, and instead of getting an orderly entry up, it gapped out of this. And so I would do exactly the same trade frame, that there is some price level that allows you to get that 2-to-1 based on a swing move down to your target. Now, I like doing that on the failure patterns in bear markets and bear markets only, because those moves tend to happen faster and bigger, and you may get all of your target on day 1 or day 2, and now you have a really short-term swing trade in a failure pattern. So that's how I propose to answer to that question. Okay, so if you asked that question, I forget right now who asked it, but if that's not clear, listen to that a couple times if you need to. If it's not clear enough, ask me again, and I will try to improve my description next week. Okay, I think there was one more question that occurred during this 3 generations of categories: mechanical, RLCO, frog. Mechanical is primarily for entries and setups, and 2nd and 3rd generation for managing and exits. I think that's a fair way to summarize what it was that I was saying. Here's let me try one more stab at it with a visual. So as I think of these things in terms of rule-based stretching towards discretionary on a continuum, right? For me, the mechanical systems are very rule-based. Mechanical systems are in this area. They are very rule-based, very little discretion. It can be some discretion, like I just showed you with the gap. And so these are those six patterns, triple screen, channeling, overreaction, triple screen, etc. As you start moving to the right, I would think of the continuation pattern then, and the failure patterns, is that there's a little bit more judgment involved in those, special conditions that make those work. The the RLCO framework itself, so this is where I would put that RLCO and Bollinger Band framework. You can now use the, and I'm not talking about the patterns, the first generation of those is P1 through P7. Those are specific patterns that can be signals. But if you just use the RLCO framework, and if you drill down intraday, you can actually use the frog pattern to fine-tune the trades that you're managing. Then this, we're now right here that we've got this much rules, but we're starting to add some discretion as well. More discretion is involved with the P1 through P7. I think of these as the first gen. The first generation RLCOs. I will also tell you we're going to look at some advanced strategies like the 1-2-3 entry, the Williams, the WMB3 entry, the auto framer, and the RLFF. These are all, and the squeeze. These are all like standalone strategies that use the RLCO framework, but they are, you're going to start seeing some rules involved in those. Then there's the first generation RLCO patterns, P1 through P7, and then there's the second generation of RLCO, which is the OWL, the Z3P, the hybrid frog, the P1 failure. All of these are second generation. They are extensions of the P1 through P7. They are refinements. So there's more and more discretion being used as you go to the side. So I think of this then in the mechanical systems. These are the ones that are in that home study course. There's some optional rules that you can use in there for continuations and failures and adding second positions or discretionary judgment about how to fine-tune an exit. At some point as you start fine-tuning the exit, you're going to recognize that the RLCO framework is a really nice way to judge, is this a good time to start protecting those profits? Has it moved such a considerable distance that the trade in the other direction starts looking favorable? The RLCO framework and Bollinger Bands give you ways to refine your judgment about those mechanical systems. I think that's a very good way to go. You can use some of these other signal generators that I call strategies, and that is they don't have the same mathematical precision of these mechanical systems. They actually have some rules that give you more flexibility for entering. But you can use the combination of them plus the Bollinger Band RLCO framework to trade. So now this is another pile of signal generators. Then the RLCO patterns themselves. Then the second generation RLCO patterns. This is where I spend most of my time, is using these patterns but on signals that came from either the mechanical or these little like the RLFF. I really like these patterns so much intraday that's where I do all my intraday trading. And then for my swing trading, I like the mechanical signals as I refine them with these patterns. If I can, when I put those together, I find that I have a very favorable swing trade performance. And that's what that 6 weeks of portfolio management that I talked about from the webinar. Yeah, when I talked about from the May 1st to April 6th, those portfolio managers, those turn out to be how I do it. I start with mechanical systems if I can, but then I apply the framework and then I manage those trades using the RLCOBB on a daily basis. And then if I drill down intraday, that's where I'm doing the intraday RLCOBB plus the frog and some of those intraday techniques. So it gets more and more refined and shorter time frame. So there's Dave asked a question. How does the end of day trade? So let me get these real quick. How does the end of day trader know that today's open was in yesterday's real body? Well, you have, as part of your trade preparation as an end of day trader, what you have to do is you say, here was yesterday's daily candle. Now, whether that was a white candle or a dark candle doesn't matter. This was the real body. So on today's trade, when it opens, it had to open inside this range of the real body of yesterday's candle. Okay? What you'll discover, sometimes the real body is so small that it's like a doji. And then on dojis, I'm willing to use the high and the low of the range. And I would call this the orderly entry. So if you have a doji, a compressed range, then I'm willing to use the high and the low to do that. Okay? So Satish asked that question that I think I just answered with the going from the mechanical all the way up to the discretionary rules and those little checkpoints along the way. And that looks like all of the questions that were asked. So we're about 4:40, so that hour-long video is almost 2 hours. So I propose to give you one last chance for follow-up questions. Otherwise, I will declare this one finished, and then we'll get the I will get this recorded and then posted on YouTube on a private channel for you, and I will put that link on the prep page that we're using for all the prep work. I'll build another little section at the top. So if you didn't hear this or you need to rehear it, then you can replay the audio. Okay? So if there's no other questions, then I propose to say you guys have a good, safe rest of your Easter weekend. Get cracking on that homework, and I look forward to your questions during the week. And again, look forward to the invite to get to the Tortoise chat room. If you don't have it, by tomorrow, then send me an email to longke@yahoo.com because or check your spam folder to see if it maybe got caught up there. But I want to make sure that you have access to that chat room so you can start seeing some of these ideas as they play out each and every day. Okay? So take good care, have a safe weekend, and we will see you in the chat room or at next week's webinar. Thanks a lot.